Hey everyone, welcome to today's webinar on practical applications of crypto and where and what will we see long-term traction across the space. My name is Saraga. I'll be moderating the webinar today. Quick disclaimer, the information contained in this webinar is for informational purposes only and is not intended as investment advice. So to get things started, we have some awesome panelists that kind of sit between general purpose blockchains, DeFi, and on-chain finance. And I always like to make any of the panels that I have the opportunity to sit on as insightful as possible. So today we're really going to try and get some of the panelists' perspective, their view on the market, and also getting a little bit of a look under hood on like how they actually analyze traction and product market fit. And they're the ones out here shipping products, which is awesome. So we're going to kind of go around the horn. I have some protocol and company specific questions for each of you, and then we're just going to kind of jump around. But I think it'd be really helpful just to introduce yourself in no specific order. Anyone can kind of jump in at their discretion, but who you are, what you're building, protocol you're working on. So actually, Arpan, we can start with you, and then we'll just go around Rok and
Rena. Sounds great. I'm Arpan. I'm the CEO and founder of Noon. We are a yield-bearing stablecoin protocol. We like to call ourselves the highest yielding, safest, and most sustainable yield-bearing stablecoin in the world. We've been around for about 18 months, down days, returning about 10, 11, 12% APY right now. My past life, how I got here, TradFi, sort of worked my way up through McKinsey, Goldman, built a bank in the UK, helped scale one of the largest crypto drop shops in the world, and then fell into the stablecoin space because I thought we could really make a huge impact on the broader global financial market.
Nice. Thanks for having me. My name is Rok.
I came here.
I'm co-founder over at ether.fi. At ether.fi, we are building a crypto-native neobank. So think of whatever your current bank does, but fully on crypto rails. So we have three main products: our stake product, our liquid product, and our cash product. Stake and liquid basically allow you to hold reward-bearing assets in crypto assets, ETH, BTC, stablecoins, or a variety of different things to kind of like maximize returns. And then our cash product is a credit card. So it's a Visa credit card. So you can spend or borrow against your crypto. We launched that about a year ago, I guess, to the day exactly. And so that product's had a lot of success. We just had our highest day ever yesterday. We did $3.8 million in transaction volume. So over $1 billion annually in transaction volume, which is super exciting. Yeah, I think that product is one of like the killer real world use cases of crypto, getting away from the casino that a lot of crypto is.
Thanks, Rok.
Thank you. Hi, I'm Rena. I'm the president of the Stacks Endowment. Stacks is the leading Bitcoin layer 2. We are actually the oldest Bitcoin layer 2. We've been around since 2018. And actually Stacks' claim to fame is it is the only token project in all of the history of America that did a Reg A plus offering in the qualified sale with the US SEC. And so we have a commitment to always want to be America first. In terms of being a Bitcoin layer 2, I think everybody knows that Bitcoin does not have smart contracts. So we were the first to create the actual smart contract layer to actually make Bitcoin productive. What we really focus is on this, the on-chain economy for Bitcoin. We actually believe in hyper-Bitcoinization. We want to see Bitcoin fees continue to generate. We want to see Bitcoin to stick around. And it's our thesis that there will be a tragedy of the commons over the period of time that no one will care about the Bitcoin network because we've all moved on to other assets and such. But if Bitcoin fails, crypto fails. And so like we feel it's our ethical duty to actually save Bitcoin and continue to make sure that the network generates. And then in terms of product wise, for us, the most important product we have on market is a Bitcoin staking product. We actually are the only protocol that offers a native Bitcoin yield directly from our consensus mechanism. And to date, we have distributed 4,293 Bitcoin in yield.
Awesome. Thanks, Rena. Rena, just given the way the horn went, I'm coming right back to you with the first question. And kind of for the audience, I think it'd be really helpful to get some of the panelists' perspective on some of the analysis they do. So Rena, you recently got like a $6 million, I think, grant that you can deploy, correct, across the ecosystem?
We do have a grants program for Stacks. I mean, I do run our grants program, but I'm unsure what. I mean, I would love a free 6 million just for shits and giggles.
I thought I saw some sort of mandate, but as you distribute grants across the ecosystem, like what is kind of the highest conviction use of capital that you see for like actually creating long-term traction? And like, how do you analyze the trade-offs when you are deploying capital across the ecosystem?
Yeah, so for us, our grants program is kind of multifaceted, but we truly believe in if it's going to create an on-chain transaction, that is the only thing that we're going to fund. And so generating fees back to the Bitcoin network. Most of our grantees fall in a DeFi kind of vertical. I'll say some of the projects that we have are doing Bitcoin-backed stables or Bitcoin lending, Bitcoin private credit markets, really creating the opportunities that you have never really seen on Bitcoin and bringing them to market. For us, it's important to see like the consumer applications of making Bitcoin productive, because everyone in the world in some period of time is going to have some amount of Bitcoin, but what they do with it, do they yield with it? Do they actually use an asset that works for them versus an idle asset is really like the fundamental shift that needs to change. In terms of traction, there's a few of our projects that are integrating, I'd say, into kind of more mainstream applications. One of our projects is actually working with Saylor's team on the tokenization of the stock and bringing that to help boost their Bitcoin yield. So it's like really cool to see the two markets converge.
Awesome. No, and I'm curious also, like, are you able to differentiate? You say you're trying to drive transaction volume or on-chain transactions. Like, do you have insight into, and I don't know if this goes into your analysis as well, like the difference between one-time transaction executors and like people that are going to sustainably stay in your ecosystem?
I'd say for us, the most of the kind of retained or like reoccurring transactions will be from like our Bitcoin staking bonds product, because you have to do UTXO transactions every bond cycle, which is helpful because we're forcing the network to actually accept a Bitcoin transaction. I think the challenge is like with L2s, even stacks to that extent, most people want to push their transactions to the L2 because cheaper, faster, better, right? But at the end of the day, if you believe in Bitcoin security, you need to pay your fees to Bitcoin miners, and that's important for kind of the entire ecosystem. And so our consensus mechanism is forced that we have to do rollups to Bitcoin transactions every block, which is helpful.
That is helpful. At least you can do that on a block by block basis. Okay, very interesting. All right, switching gears, Arpan, over to Noon. Was just running through the website, and like you list 7 different sources of yield for your stablecoin and your staking product. I'm curious, like walk us through some of the core drivers of like what are the main sources of yield doing the heaviest lifting of like that 11% APY, and like what sources of yield do you think stablecoins are most dependent on today?
It's a good question. I think those are, so for us, the way that we look at our mandate is to offer a user a single yield generating product that is kind of set it and forget it. So they can put their capital in, they can rest assured that it's buying the highest yield with the lowest amount of risk, irrespective of economic cycles. So we have 7 yield sources now. We're in the process of evaluating a handful more that we'll probably bring to our community for a vote over the next few weeks and months. And that'll continue to grow and expand. So this is never going to be static. It's always going to be dynamic, and it'll move with the markets. To your question, right now, because of where we are in the cycle, a large amount of yield, that's 11% that we're generating right now, is coming from more counter-cyclical yield sources. So think about loans, private credit, debt, that kind of thing, because that's frankly what is really returning right now. A lot of the deployment strategies we have, like DeFi focused or even CeFi focused, just haven't been returning in this market. And therefore, we've, again, our automatic allocation system basically just reallocates our resources on a extremely regular basis, and we optimize our allocation depending on what's happening in the market. To your second question, in terms of what is generating a lot of yield for yield-bearing stablecoins, I think it really depends on, I guess, which part of that yield-bearing stablecoin market you're looking at, right? And that market ranges from people who are doing pretty plain vanilla T-bill backed yields, which is frankly a huge part of the market.
Yep.
You have people who are doing sort of something that is extremely black box, right? Where they're effectively running a tokenized hedge fund and you're just committing capital to their strategies and you don't really know what's happening under the hood. And basically everything in between, right? I'd say a large part of it is still the assets that are under management are still locked into the T-bill rate or something like that. And we're seeing people try to diversify away from that because T-bills obviously haven't really been printing for a while and look like they're going to continue to reduce the rate that they're giving users for the foreseeable future.
Interesting. So you have a cyclical strategy, more or less, that's market dependent or counter-cyclical, like you said. Like, what does that involve then from like a risk underwriting perspective? And like, I assume you have some sort of risk parameters in place. What does that look like?
Yeah, so I wouldn't call our cycle cyclical or counter-cyclical, to be clear. I would call our strategies, our allocation strategy, at least as dynamic. So we have strategies within our permitted basket. Some of them are more cyclical, like, for example, DeFi lending, very cyclical strategy. As DeFi markets go up, those rates start printing and we'll sort of start allocating more towards that. And a lot of what we're in today, like private credit, is counter-cyclical. We have very extensive risk management and controls that are around each one of our strategies, and then obviously how they all interact as a full portfolio. So for each strategy, we do a very rigorous risk assessment. We make sure that we look across a multiple amount of risk categories to make everything from counterparty risk to market risk. Basically, just look at your traditional bank underwriting process, right? That's where I've sort of learned this from. That's where we sort of look at our North Star. And we make sure that we are as rigorous about what we're diving into, what kind of risks we're taking on, including things like credit risk. But then we also talk about what are the operational risks that we actually have to actually deploy. And that's where this can get quite complicated. But it's been really, really rewarding to see a lot of the decisions we made very early on to say, no, we're not going to take this, because even though it might look really, really juicy right now, we think there's a huge fundamental risk there, really start to pay off as we see unfortunate events start to percolate in the market.
Yeah, understood. Are there any in terms of traction, are there any like new sources of yield that you're exploring, or you think the stablecoin market will eventually adopt?
Yeah, right now, I mean, I think a lot of people
But you're able to share.
No. So something, I mean, we're gonna publish this live in the next week or so, but to Rena's point about strategy, there's a bunch of new stablecoins looking at preferred vehicles from digital asset treasury companies like Strategy. And there's obviously a handful of these digital asset companies that look at not just Bitcoin, but ETH, Solana, and sort of a long tail. There are now all starting to issue preferred vehicles that are kind of a mixture of equity and debt. They sit in between them. They aren't senior, so they're junior tranche, but they give out a dividend. And this regular dividend is what is really appealing to yield-bearing stablecoins. Now, obviously, the risk there is, for example, if you look at strategies weighted average entry price into Bitcoin is pretty much what the current Bitcoin price is. So if you start saying, hey, I'm going to deploy 100% of my assets into a preferred vehicle like this, and Bitcoin price tanks, that preferred vehicle not being quite junior in sort of the cap stack is probably not going to perform well. So sort of the science here, the risk assessment here is not only, hey, listen, is this a good risk and is it creditworthy, but specifically under what circumstances is it creditworthy? Because we're a stable coin, right? We can't have down days. We can't lose our customers' money, even we can't depeg even by like 50 basis points. So the question is, under what circumstances, under what controls, what processes do we need to have in place to make sure that any allocation that we put into this or any other new strategy is actually going to be really safe?
Okay. I don't want to say I'm switching gears, but Rok, from your perspective, like, how do you analyze offering different stablecoin yield products like within your own platform? What does that diligence look like? Does it differ at all?
Yeah, we don't offer a bunch of stable coins right now. Like we've kind of limited the amount of assets that we offer currently. So it's just USDC and USDT. We don't have anything that is yield bearing currently on it. Our goal is to have more assets on there, but we want to make sure that like we can protect people's capital too. So like, first and foremost, we look at like protection of capital, and then kind of we'll go forward from there. In DeFi specifically right now, I think the market's spooked, just like with all the hacks and things that are going on. So like we're not going to get too far out on the risk curve right now as far as like assets and where they are. The best way to get access to this stuff is through our liquid vaults. Our liquid vaults basically like capital goes in them, and then those are deployed in different strategies to earn returns. And so some of those will go in like different, like our stablecoin one, our USD vault, will go into different stablecoins or market neutral strategies to kind of earn returns. But the curator and how they look at things is more, it's like liquidity, risk, et cetera. And so, I think you can get really far out on the risk curve on some of this stuff, but ultimately, if your capital is at risk, like it's not something that we'll kind of take a gamble on. The curators go through that. Like we actually don't do that at ether.fi. Our curators, nonce capital, they kind of run through that. But yeah, I mean, I think that in general, why people came into crypto was like outsized returns, right? That was the initial reason people came in and got there. It is still a very yield hungry market, and people will kind of forget about risk to get yield. One of the things that we're really working on is just bringing like real world utility to crypto. So I think that whenever people are searching for outsized returns, that's the casino portion of it. Just like the stock market is a regulated casino, and like there's certainly a role of the casino in the world, like a large role in the financial world. But like we want real world utility, and so that's why I really focused on like the card and bringing that to market. So yeah,
it's like everyone wants yield and as much of it until their capital is gone, and suddenly now all of a sudden they're all focused on risk.
Yes,
the classic crypto.
Yeah.
So from your perspective, just like kind of give us a little inside look at ether.fi. Started kind of from my perspective, like with the restaking products, how I was familiar, and then now it's kind of like this kind of neobank to a degree. Like, where do you see the company heading? Like, where do you think the most traction is going to be across your product set? Like, where are you allocating the most resources today?
Yeah, for sure. So the card is where most of our resources are allocated right now, the cash product and getting that out there. We are, I guess, like if we're doing our jobs right, our biggest competitors in 3 to 5 years should be Revolut, Robinhood, Coinbase. So it's like this mixture of pure Web 2 neobanks, which is like the Revolut, the Robinhoods of the world. You see them getting more into the Web 3 space, right? Like in getting more into crypto. Coinbase is kind of this hybrid, like Web 2, Web 3, and we're like fully Web 3. Being a DeFi protocol and not taking custody of assets allows us to move a lot faster, which is great. So like our TAM is the world, where a Coinbase, a Robinhood, a Revolut, like they have to go through and get licensing in all these different places in order to move. And so speed is our friend, and we can move faster because of our like the non-custodial nature of our platform. So I think that's like what's super, super exciting. One of the trends I think that we're looking at as a company, it's really interesting to see like specifically, people talk about like what is going to be the new currency that's like a global currency, right? And there's the thought that the Bitcoin could be it because everything's getting hyperinflated. And candidly, I just think the U.S. dollar is very clearly the dominant currency. I think the U.S. government has made some smart plays, like getting behind stablecoins, because they see a net buyer of treasuries. As China dumps the treasuries, there's a net buyer out there because the majority of people actually want to get into the U.S. dollar. And so there's this fascinating thing, almost backwards way that crypto has kind of helped the U.S. dollar. And so like we have customers across the world. The most popular thing for these people to do is to get their whatever their local currency they get paid in, get on chain as quick as possible and get in US dollars. That is the quickest thing that they want to do. So we see that across our users. But yeah, I mean, I think that like, I do think the next wave of banks or neobanks or whatever, financial institutions where people keep their funds, I think are being built right now. So I think it's a super interesting time actually. And, I mean, you see this, right? Like the growth of Revolut, the growth of Nubank, the growth of Robinhood. So all those are really good examples. One thing that we think about that, like, if you go like Robinhood in and of itself is like a negative EV app. People who go to Robinhood the more you go there, the more money you're going to lose. Like that's just kind of the reality of it. It's why financial institutions currently where you like can't make your own trades are better because humans are emotional and having that at one touch is not good. So how do we like be a positive EV place where people come and they can get their money there and like we'll make money and maybe holding ETH is not the best thing to end up making money. But yeah, anyway, that's kind of one of the things that we've thought about, or like how do you make it a place where your finances grow instead of go the opposite way?
Could be after the call possible synergies between you and Arpan if you want to go
For
further
sure.
and further down
Yep.
the stablecoin market. I mean that's like I was gonna go around the horn here. I think there's a pretty obvious like elephant in the room and answer just around like what is the one application of crypto that you think kind of achieves mass adoption. I hate that everyone throws that out because like there's just so many avenues and potential use cases for crypto. But like I guess I'll start. Like mine is stablecoins, and it's always a little bit annoying and difficult to having the conversation with people when they want to hear the investment thesis behind blockchain. And I'm like, oh, the investment thesis is US dollars. And they're like, what? That doesn't make any sense. But it's like, at least here in the US, it doesn't make sense. But people aren't realizing, I think, how much TAM there is in other countries. And then obviously how like supportive stablecoins are for our own debt position here. But like, if we were to go around the horn, what do you all think is that one killer app that achieves mass adoption, actually demonstrates the most traction? I'm starting with stablecoins. It's probably the easiest answer in the room. Rena, you can start.
I mean, I definitely agree it's going to be some sort of like savings banking product from like the practical standpoint, but from the idealistic of what I would actually want for it to be as like the mass adoption, I still believe in decentralized storage or something to that nature. Like we've seen GitHub issues, AWS cloud issues, like entire exchanges getting taken down by like one server, and like that like truly should be the practical use case. I think that's what like Gaia was built on the Bitcoin network for, to do like decentralized storage, ordinals, all of these things. But nobody cared because AWS was good enough until it wasn't. So like my heart would like to see that.
I've read some stuff recently though that like there's technical barriers from decentralized storage. Like it's not really an efficient way.
It's not, but like back in the crypto days, I don't know how many remember Arweave as a project, like that was doing decentralized storage, but like I would love to see one killer use take off in that because I think it's necessary.
Fair enough. And then we just have to figure out a way to tie the tokenomics to the project so it's actually an attractive investment opportunity for.
It's fine. Points program, salt.
And that comes back to, okay, are we incentivizing short-term users and not long-term traction?
Decentralization is important until it actually applies to you. And I'm like going to die on this hill. Like this is the reason why I got into Bitcoin 10 years ago, is the idea you need something that no one can take away, and like the entire idea of self-custody and that. And everything that we're doing in crypto feels like a shift back because of risk tolerance, which I understand, but like there needs to be a median of like threading the needle of decent risk, but still maintaining like the ethics of crypto and like why we came into this ethos.
Understood. All right, Rock, your take. I feel like Rock and Boomer should be like the name of a podcast or something.
Oh, there you go. Rock and Boomer. ether.fi. That's clearly it. No, honestly, like I do think that I think it's a neobank that gets mass adoption. So I just think it's a better way to bank. If we see stress on the financial systems here, like I don't think people really know how banking works and that their assets do not sit at banks. And so if that ever unwinds, disaster, kind of blows up here. And so self-custody is going to like kind of play there. So there's still a ton we need to do to make self-custody more safe in like security and whatnot. I actually don't think self-custody is a good idea for most people.
Yeah.
But we need to get to a place where it is the right idea for everyone. Because ultimately I think that's kind of what it is.
The funny thing about self-custody is it's so secure that I have had so many people like approach me and be like, can you help me get my assets out of my ledger? Because I don't know how to use it. And I'm like, the good news is your funds are safe. The bad news is you have no idea how to use this. So I hear you. And it is also something that it's like, what's the question that keeps you up at night? It's like, I actually have been thinking a little bit about like, if there is stablecoin mass adoption, like, is there a run? Like, is there a bank run essentially? And like, that's what the ABA is like fighting for right now with the Clarity Act is like around like the stablecoin rewards. And it's like, yeah, if I'm a bank, I'm actually petrified. I would have been trying to create my own stablecoin for quite some time now, but like, yeah, I'm petrified. You have two options. You have one where you're lending against a balance sheet and your assets just sit with the bank. And like you said, like your assets are not really there. They're gone. They're immediately lended to some commercialized loan. Or it's like I have a stable coin and I know the only thing behind my 1-for-1 peg is a T-bill or, some algorithmic like risk parameters that's securing my funds. So it's just like, I think about that often, and I'm sure there's going to be some protections in place. But okay, fair enough. Do you, Rock, like you said, the neobank you think is going to be the end winner? Why a crypto native neobank and not a traditional one, other than maybe just like the bank run concept?
Yeah, self-custody, I think that's like ultimately what it is, to be honest. So and it's more cost efficient. I think people can get like less fees and whatever. There's less middlemen across the whole like thing on this. So and I don't think you need to look further than like Aave lending markets. Like if there's more size in there, rates would be cheaper and there's less people who need to get their hand in it. So like less bips. So it just becomes like more efficient, right? It's market to end user directly instead of originator, bank, loan officer, right? Like the 7 hands that need to eat on a loan.
Maybe we just refine the collateral set at Aave and get it down.
There it is.
And then we'd be good. Arpan, what's your perspective?
You know what? It's really frustrating. I think you guys have taken all of my favorite answers because obviously the reason I'm in the stablecoin space is because I think stablecoins have the coolest opportunity set. And obviously being sort of an old banker, I think that is a market that's ripe for disruption. And I think that crypto and blockchain technology is right at the forefront of how it can be disrupted. Let me answer the question a slightly different way, since you guys have taken all my favorite answers.
Or I could get you back on the other side too. I can ask you what has the most noise, but go ahead.
Well, let me give you mine, and then I can try to answer yours. I think what's really cool about blockchain technology is, again, in my naive opinion, I'm not sort of a massive technologist. There are so many people in this world who know this technology, including probably all 3 of you guys on this call. But in my naive opinion, I think blockchain, the really cool thing about it is actually the ability that it has as an infrastructure layer to change the access that grants people. And I think the really cool thing about what you said at the beginning, Boomer, about how the use case of blockchain is USD, is what I think, again, what I took away from that, it's not actually USD, but what it is, it's access to USD for every single person on this planet who may not have access to it, right? Similarly, I think, Rok, to what you were saying, like you can have a bank and you can have a bank that's fully regulated and within a certain jurisdiction, that's probably fine. But when you want to try to sort of increase access to that across the world, across geographies, that's when blockchain really, I think, comes into its own and really shows like a really, really interesting and differentiated use case from any previous technologies. So I think the first use case, the most obvious use case is, I think, the one that has the most constraints about access geographically. And I do think that comes down to regulation, and financial services is right at the top of that list. But I think anything else that is geographically kind of bounded from an access standpoint and has the greatest demand of sort of permeating those kind of barriers is probably what is going to have the most adoption, which is why I really think that financial services and specifically stablecoins within financial services are at the very top of that list.
But awesome answer. And I'm thinking about it on a more of a secondary level now. It's like, okay, blockchain opened up access to stablecoins as a primary level. And then you see, okay, why is BlackRock and now JP Morgan and all these various counterplayers like so focused on creating investment vehicles that live on blockchain? To your point, Arpan, like I think that now the next layer is actually access to US markets and our investment markets that most people don't have access to today. Now, obviously, there's like a KYC AML component that would need to be implemented or at least streamlined. But that is what I see as this bubble. I don't want to call it a bubble. It's not the right term. But this market growing larger and larger and larger. So I think that's a really interesting point. All right. Well, since we took all the answers and you had to kind of break it down at a more granular level, we'll switch gears. What narrative do you think has the most noise between? I mean, there's like all these different. I don't want to call them trends, but like there's decentralized AI, there's tokenization, there's on-chain perps, there's privacy, there's the classic buzzwords. Like, what do you think does not actually have long-term product market fit, and like we will not see a couple years from now? The NFT equivalent. Well, I don't want to say NFT, but NFT.
Yeah, I think the examples you gave were very specific. I'm going to go with something a little bit more general, and I think this kind of has been over for a while now, but I think people keep trying to sort of play this playbook over and over again. And that's kind of leading with incentives and incentivization. And that's specifically like token-based incentives and incentivization. I think that it may come back again, but that kind of unsustainable incentive structure, I think, is causing a lot of projects to kind of sort of build a system that where the tail kind of wags the dog, where they're like, hey, listen, if I incentivize enough people, will we get enough users in order to actually find product market fit? Or some probably more eloquent version of saying that. But I think that that is something that has been dead for some time now. I think it's taking a lot of projects and protocols a while to get comfortable and familiar with that reality, because it was so effective in 2020, 2021, parts of 2022. But I think that as more and more people get aware of that, but right now, retail doesn't really care that much about incentives. And when I say retail, I mean like traditional retail, which is actually pretty sticky. The people who really care about this incentives are very mercenary, be they retail or institutionals, and they will move whenever incentives move. So these incentives will maybe get you short-term attention, short-term TVL, short-term capital, whatever the metric is that you are driving with these incentives. But the moment those incentives expire, and they will expire, you lose all of that, and you're kind of back not just at square one, but you're a little bit behind the 8 ball now, because now you're in the same position, but now you don't have those incentives to give away again.
Yeah, I'm a big opponent of incentives because it's just short-term traction, in my opinion, and I've seen it across various business models. It is kind of ironic, though, that like at least I got into crypto in 2017. I was a big participant of DeFi Summer. The reason I was such a big participant was because I was yield farming like a lot of my peers. And the irony is I don't use any of those protocols anymore, and 90% of them are dead. But it did bring a lot of users to crypto that are now long-term users. And so on one hand, like I view it so negatively because I have a different hat on than I do today than I did prior. But on the other hand, like it was kind of net positive. Like a lot of my peers that I know came into crypto because of DeFi Summer, and it was all incentive driven, and it was all artificial yield. So it is the trade-offs are difficult to analyze. And Rena, that's kind of what prompted my question earlier. And I am curious to get Rok and Rena your opinions on this. But like how to actually analyze short-term versus long-term traction, especially when you're in the seat of potentially controlling distributions and grants and subsidies. To make sure that people don't just like come eat.
They come and they seek the grant, they do whatever minimal viable product and like run right off into the sunset, right? Like I think every treasury, every foundation like faces this problem of who actually has incentives aligned from a financial standpoint, but actually like the chain's mission, which is becoming more and more rare because no one is like chain loyal anymore. I think you're going to figure out which composable structure works best for you. Going back to your question on what will probably never come back, I'm actually going to go with DAO governance. I don't think people care about DAO governance anymore. I think the idea of like doing a DUNA and doing this like decentralized governance because we all want to actually architect and vote on a protocol. No. Like, I actually think this is the one thing that should die in the crypto landscape. We've committed to some level of, let's call it not necessarily centralization, but some level of there needs to be adults in the room who actually can run the protocol as a business. Therefore, you can't have the largest token holder who might have bought from XYZ, years ago, hold, sat, whale, and gets to control the protocol. Not going to happen anymore. So I would take on DAO governance. I think the Aave example is maybe like a good example of like, did the governance work out in its favor? Did it not? Did it make the right decision? Is that how a business should have operated? There's mine. Second, SocialFi, still dead. No need for it to come back.
Speaking of incentivize and subsidies to get users, but isn't it kind of funny just on your point on like the DAO model not working? It's like couple hundred years of polishing off like what a business structure should look like, and having a board of directors and having advisors and having a figurehead and a CEO, and then crypto comes along and is like, no, we're going to rewrite all that, it's going to be way better our way. And it's like, well, not exactly.
And then like 10 to 15 years later, we're kind of where we are now. We're like, maybe we were wrong.
Yeah, I think it would be an interesting proposition is like kind of having some sort of like protocol constitution essentially, and that maybe gets voted on by like token holders at the onset, and then like that is the guidelines that those who get appointed to govern the protocol have to abide by, something along the lines of that. Really just like a formalized structure,
like a manifesto that you must abide by,
like a manifesto, like an on-chain manifesto. I think that could have potentially some legs if someone wants to explore it. And I know that kind of like the consortium model now of having like your highest strategic participants at the top kind of pulling the strings, or at least directing or guiding the protocol in some direction. But that is, I like that perspective. Rok, any dead fish out there that you think aren't coming back?
No, I was going to say decentralized protocols. That's call it DAO governance, call it whatever. But if I look at in DeFi specifically, like a lot of the things that have kind of like the smart contracts haven't failed us. The individuals running the protocols have failed us, and DAOs allow people to hide behind this like veil of like, oh, I can't do anything, which is it's kind of stupid. I think that's probably over and run its course. So that's the biggest thing I think, to be honest. I also think tokens, we'll have to see where tokens go here, but Yeah, like a lot of people launch a token. It's a marketing scheme, right? This is the points, this is the incentives, whatever, and you have this token. And unfortunately, it allowed a lot of people to just get like quick wins from a financial perspective, and then not, no protocol or no company is built in like 1 to 2 years. Like, a startup's like a 10 to 15 year journey at least. So like, but people got their bag, and so they left. And so, because that was their intention, right? It was, hey, I need to build this to make a bag, not, hey, if I'm going to build this to make a difference, or like, I think this like improves the world or whatever it is. So, yeah, I think tokens, especially like, tokens that don't have clear value accrual are probably in trouble.
Yeah. Do you think we move closer to like protocols transitioning to tokenized equity, or do you think the tokens themselves begin to accrue equity-like properties? Which direction do you think we go in?
I don't know. It's something we're looking at like a lot on this. So because I don't think there's a clear like pricing of tokens makes no sense. There's no fundamentals, whatever.
Can't.
Yeah, exactly. So like you look at some of these tokens and like the valuation, like, it's like insane. And then you look at like some good ones in like kind of the revenues behind it, and you're kind of like, it seems bizarre,
It
right?
makes
Like,
no sense.
Totally. So anyway, that's kind of like where we're at on it. I don't have the right answer.
There's no right answer.
Yeah, but I think ultimately, like, there'll have to be more utility than there currently is.
Yeah, it's so hard to value a token when like 50% of it comes down to utility and like how it's utilized. And I think that's the biggest differentiator between equities, of course, is like you buy an equity, it sits in your account, and that's it. You're not utilizing
Totally.
it. There's no function. So it is, when I'm always putting my valuation hat on, it is kind of tough because there's a component or a side to it that's completely like, I guess, economically driven. It's supply and demand essentially.
100%.
Yeah, so it's tough.
That's the majority of it, right? Like whoever controls the supply, like,
Yeah.
It's like you look at a lot of tokens out there. It's just those who've done the best job of like controlling supply are usually controlling the price the best.
Yeah.
So two things. We've just recently launched a token. We did a huge exercise on how do we do this properly? How do we do this right? How do we sort of avoid some of these pitfalls that we've seen in the past? And I think to the points you guys made, we tried to see how we could address that. So first and foremost, I think the point of, everyone launches a token, team invests in 2, 3, 4 years, and everyone pieces out. What company is ever going to actually gain full traction in 3 to 4 years? It's impossible to see, right? So everyone on our team invests over 7 years. So I think, again, that doesn't solve the problem, but hopefully that moves us in the right direction. And secondly, from day one, we always said that our token needs to have actual revenue accruing to it, even if it's indirect, right? Because can't really do it directly. So indirect revenue accrual is super important from day one. So there's a way that we've structured it so that there's always something that the token holder obviously needs to do. So it's not passive. So they need to stake the token. But once they stake the token, there is revenue coming back to them, or there's some upside that they get. So technically, even though we don't do it now, you could run a DCF on it and value the token as a traditional equity instrument if you really wanted to sort of go down that path.
The tough part, I've run a number of DCFs on tokens. I don't know, to my own demise, and it's just like so frustrating when your valuations are just nowhere near the token and then they never converge either. The anticipation is like, okay, free market, this should efficient market, this should over time come back or drop from and it's never even close. But I agree with you, Arpan. I don't know if you guys looked at like the aerodrome model before you went to market with your token. Yeah, like it's just a flywheel structure where everybody is participating. The fees are all being distributed properly to those who are within the ecosystem and supporting and kind of incentivizing that flywheel where then no one ever leaves. It's easier said than done, but I think there are a few examples. I'm keen to, after this call, I'll jump into your tokenomics, and I would love to take a look. All right, so I guess kind of wrapping up. I think we still have some time, right? Yeah, we got 15 minutes or so. I don't know if we have a hard stop or anything like that, other than y'all's busy schedules. But just on I guess the topic of what has a lot of noise, what do you think's been like the biggest barrier for traction so far across crypto? It's a pretty high level question. From my perspective, it feels like I don't know if this bottom up approach of having users first, which was incentivized by a lot of the token subsidies across the space, and now institutions following and fighting, versus like the traditional model of institutions bring products and then they attract users and then it's kind of easy. So, Rok, I'd be keen to get your perspective on this, just because you're running I would say a business model that is somewhat traditional in nature, but it's obviously crypto native. So what do you think's been like the biggest barrier so far, just for mass adoption traction?
I think safety. I honestly think that's the biggest thing. So like one of the things that I guess safety and user experience, I think those are probably the two things. Like DeFi is like, I don't know, you get in there and like it's literally the worst user experience. The first time you do something in DeFi, you're like, what am I doing? Like this is clearly fake, and and then you start to do it and it actually gets like kind of addicting, but you have to be kind of stupid to first like get into it, to be honest, like because it's just like, I don't know, you need to trust someone that like
Naive.
Yeah, exactly. And then like you kind of mess around with like some dollars and like start to kind of like, oh, it's actually real, whatever. And so I think DeFi Summer brought people on because like the rewards were like so good, right? And so but anyway, I think the user experience just needs to improve massively. Like yeah, so we've kind of had this interesting thing of how do you make it like a normal user flow, like with a email address login type of a thing, passkeys, compared to, having the wallet, connecting a wallet and like signing and getting it. And so kind of navigating that has been pretty interesting, I guess, to be honest. And then I think security is the other thing, like just because these smart contracts are, like there's been so many hacks this year. And I think that's the general sentiment is, like with AI kind of going the direction it is, people are concerned. And so you need to go with like battle tested companies. Like I think it's gonna be harder and harder for new companies to launch, and they won't grow as fast. It'll probably be like a normal, trajectory where like we grew super fast in like a 6 to 12 month period, which is crazy for a startup. That just doesn't happen. But now stuff will be like on a more traditional path where like you slowly earn people's trust over time, type of a thing. So yeah, but I kind of compare it, if you think about like the Wild West in America, like there are bank robberies all the time, right? But now people feel the best place for all their money is a bank. But like, rewind 150 years ago, 200 years ago, whatever it is, like banks got robbed all the time. But they now have like necessary security stuff in insurance, whatever. I think crypto will go the same path. We just have to get those things kind of in place, and the protocols that have been like most hardened or battle tested will be, the ones that kind of persevere through it.
Yeah, and love what ether.fi is obviously doing. Like A, very focused on security. B, enhancing the user experience to abstract a lot of the complexities that I think exist within like on-chain finance and trying to use a traditional Web3 wallet. But something I always like pondered is like, why is the user experience so bad? You have some of the top developers all over the world contributing and shipping code. I get that like the infrastructure is brand new, where you're essentially replacing financial infrastructure plumbing. So you're replacing the foundation, but like, why is it that the user experience was so bad and it's taken years to fix? I mean, we're just getting there now where you have products like ether.fi that really streamline it. Like why? What do you think your take is on that?
Yeah, I don't have a good answer for it. I mean, I think it was just kind of this like initial idea that people had, like the UX didn't matter as much, and you got to kind of prove out the financial system, and it just kind of took off, and that just kind of became commonplace. But people are certainly working on user experience now. It seems to be improving immensely across the board. But yeah, I think that and rightfully so, people were focused on like security and decentralization to gain trust of people, right? So like some things certainly should be decentralized, and like blockchains and whatnot. Like those cannot be fucked with, right? Those should be, the code should be immutable. Like, kind of leave it out there and let it go. People who are building on top of those, right? Those are the ones that probably should be a little more centralized, and code shouldn't be immutable, etc.
I would love to hear a developer's perspective. They're like, yeah, we were really focused on security. We didn't care about user experience. And I was like,
yeah, I don't know. Yeah, I don't know. It's kind of like it's kind of like an aura of the early crypto people too, right? They almost took pride in it.
They did. Well, that's like the old Curve interface. So I should just say
Right.
the Curve interface in general. I was a bit of an opponent of that. I didn't think it was. I didn't understand the attraction. But I don't know. Arpan, Rena, you guys have any opinions?
I mean, personally, I think that crypto UX was horrible for the last 10 years because everyone was trying to circumvent securities laws or things like that. You're trying to be like, oh no, we don't KYC, we're non-custodial, therefore we will not make it simpler and cleaner as an interface to use. So I feel like that was just some historic baggage that we all probably felt, and as regulation has changed a little bit more forward, maybe that baggage can be unpackaged. I think for me, some of the barriers still are trust, reputation, and actually relevance. So in the sense that not everybody feels the pain of needing decentralized money every day. Most of the Western world doesn't need it. You're using it to add value to your life, but you don't need it for everyday transactions. Other areas of the world, it is desperately necessary to have decentralized rails. But I think one of the ways that we might circumvent this is how we all interact with agents going forward. And if we're going to have agentic agents controlling your wallets that access your subscription accounts, your Ubers, your what have you, and kind of handling all of the consumer-facing headaches of daily life that no one wants to deal with, arguing with why is my bill higher than it should be, XYZ. I think that might actually shift how we interact with crypto.
I want it to work so bad, like agentic payment, because it sounds so great in theory. And it's one of those narratives that I would love to get behind. I just want to finally see something actually come to fruition.
I'll give one for Rok because I have an ether.fi card tied to a decentralized agent and it controls my Uber account. So when I'm like, hey, right now you have my calendar, you know where I need to go, X to A to B, you know how much time I need from area to area. My rides are booked, my agent does it, and it's all via an ether.fi card.
That's super cool. That's
Yeah.
awesome.
You should have led with that. You've been holding that in this entire time.
Had to wait for it.
Is that a proprietary agent, or is that through
It's an OpenClaw. No, it's through OpenClaw. I just built a little agent. It's on a Mac Mini. It controls my calendar, and it's my toxic habit is I hate being late for meetings because I'm on Indian Standard Time, which means we're always late. So I'm trying so hard to not be late. So now I needed to outsource that I would stop talking and get in the car.
Oh my gosh. All right. Well, Rok, you might have just picked up another ether.fi user over here.
Nice. Yeah, you should give it a try. It's great.
If I can connect it to, I was thinking about that for restaurant reservations as well. Just it's such a pain in the ass process. And
Give it its own email account. Everything's ring fence the card in particular for what it can access. Make sure it doesn't cross over to your other things. So my calendar has a dummy calendar that links to the one that the agent has, and the little agent handles all of it. And I don't have to worry about cross contamination against my personal access.
Oh, that is okay. I might be doing some exploring over.
And give it its own password manager that's not the same as yours.
Duly noted. That is the financial separation of just having a card. It's preloaded. This is all the money on it that it could probably draw from, and that's it. And kind of a peace of mind kind of thing.
It comes in handy, but these are the things that actually makes crypto accessible and usable for normal people who may not have use for it. Not everyone wants to buy and hold, or not everyone is into the stock market or equities market. Part of the world still just owns physical gold. So you're trying to find other uses to weave it in that actually just makes your quality of life better.
Yeah, trying to get out of our crypto echo chamber of everybody else out there. Arpan, I think we have time. Your perspective, any barriers
Listen, I'll be quick because I think everything's already been said. It's safety, it's complexity or UX, and it's real world use cases, right? And I think to the point of complexity, I think we need to stop building for what has made us successful in the past and start building for the next wave of users. I think that's kind of what you guys were all talking about, right? Like early crypto adopters enjoyed and almost like reveled in how complex UIs and UXs were, because it was kind of like a little bit of a badge of whatever to say that you were able to get through to this. That's what I think everyone was like, all right, cool. Like if this works and it has worked in the past, let's just build the same thing over and over again. But yeah, more and more people are focusing on it. It's great to see. But yeah, the real sort of, I think, supercharge will happen when you have a really smooth, streamlined UI UX with a markedly improved real world utility and use case, which isn't just like an incremental better than, but that like leverages true blockchain, something that only blockchain can provide, that helps you get like a huge step change in your outcomes. So for example, the reason why stablecoins and financial services, going back to your earlier question, I think are right at the top of that list is because I think blockchain is uniquely able to kind of provide the level of transparency that's necessary for things like, for example, rehypothecation, which is exactly what you guys were talking about at the beginning, right? Every bank in the world does that. Can any financial institution provide that level of transparency that blockchain technologies can? No. So that unique use case, I don't know if that's necessarily the exact one, but that type of use case where a really simple UI married with the advantages of blockchain technology, I think that's something we haven't hit on yet, even though I think all of us in this industry and on this call are trying really hard to get there. And I think we're making some steps, which is great.
That was the best outro of all time. I'm gonna give you. I wish you had a mic. You could like a fake mic. You could just drop out of the camera frame. Yeah, call it there. Well, I think we have come to time. Guys, this was an awesome conversation. I hope it was insightful for everyone who's listening and tuned in. It was definitely fun. If anything, any questions, I think you guys can all be reached probably via socials, probably X. But 3 rock stars here, so I'm glad we could do this. And with that, have a great day, and signing off.
Appreciate it. Thank you. We'll see you. Bye-bye.
Thank you so much.
Thanks for your time, guys.